Greetings and welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA Edge and CEO at Trow, TPSU, and 401k TV. I read all of last week's stories and select the most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story, Bloomberg Law is reporting a surge in new DC lawsuits with a recent spat against plans using BlackRock's passive target date funds, citing poor performance and poor results due to their two retirement strategy, which freezes trading at retirement. These lawsuits have been filed against Microsoft, Capital One, and Marsh McLennan. Euclid, a fiduciary insurance provider, claims no one is safe now and that plan sponsors can't win, questioning whether ERISA lawsuits should cite performance with the benefit of hindsight, which provides further proof of the claim that I made in my column this week that smaller plans and RPAs will be the next target. Next story, speaking of large passive investment providers, the Wall Street Journal noted that the big three, BlackRock, State Street, and Vanguard, collectively have $20 trillion under management, with big percentages of publicly traded companies, and have recently become more active shareholders, especially when it comes to ESG policies. A case in point, the three fund companies own 21% of ExxonMobil and have backed an activist ESG shareholder for the board, raising an interesting question. If these fund companies are not smart enough to pick individual investments and stocks, why are they smart enough to influence company policy? And what about investors in passive funds which may have different views on ESG or want their investments to be focused solely on returns, not politics, which is what a small new indexer, Strive, is advocating? Next story, in the red-hot RIA M market, is it slowing? CI Financial, which grew 71% this past year to $112.6 billion in June, is predicting slower growth this year, perhaps because it expects to go public. Rudy Adolph of Focus Financial, which is already public, noting very high valuations, called competitors drunken sailors last year, and have predicted recently that the party is over. Yet David DeVoe, a leading RIA investment banker, said that valuations have yet to compress and that fortunes favor buyers that are already sitting on cash, perhaps because new PE money may be harder to come by with higher interest rates and valuations of private companies approaching public levels. The much smaller RPA M market, which has lower valuations and is 2 to 3 years behind the RIA market, remains hot, with valuations holding steady for the top firms. Buyers like Hub and Marsh Mac are focused on acquiring wealth management firms in areas where they already have RPA offices following the CapTrust playbook. Next story is, while the U.S. may be the leader in participant and individual-directed retirement assets, with almost $25 trillion between IRAs and DC plans, it's still important to review what other countries are doing. PGIM's Josh Cohen notes 6 lessons learned from other countries, including Australia, Singapore, Chile, and the UK. These lessons include DC plans are much more popular than DB plans as companies and governments shift liabilities to individuals. Secondly, the debate over voluntary versus mandatory plans continues, with sentiment favoring mandatory. A safety net like Social Security is necessary. Professional investment management used in DB plans perform better. Retirement income is still a conundrum. And finally, there needs to be a balance between the private and the public sector. So nothing really surprising here, but as the global economy grows and becomes more interdependent, it's important that retirement systems are aligned. Finally, in my column this past week on wealthmanagement.com's RPA Edge, which got almost 8,000 views on LinkedIn alone, I noted that the coming reckoning over participants would start between record keepers and broker-dealers, not the larger RPA firms. Broker-dealers have many more advisors with varying levels of experience and exposure and have much more developed rollover and wealth management capabilities. Using a range war analogy, the advisors are the farmers who want to protect their land using fences, and the record keepers are the ranchers who want free range for their cattle. The participants are the land, and the data is the water. Hopefully, record keepers, broker-dealers, advisors, and RPAs, as well as money managers, can find a way to collaborate, protect their respective businesses while helping people better prepare for retirement, all of which will be discussed on September 7th through 9th at the Record Keeper and Broker-Dealer Roundtables in New York, sponsored by wealthmanagement.com's RPA Edge. So those are the most important stories from the past week. I also published on 401k Real Chat, my new column, my new program, an interview with mindfulness and meditation coach Lauren Lanning, who is also an RPA, about how meditation can help people with financial issues. I listed a few other additional stories that I thought were worth reading. Please let me know if I missed anything or if you have any comments. Otherwise, I look forward to speaking to you next week on 401k Real Talk.